7th. Out of the building again today. We're talking taxable income. I'm back in the building tomorrow for 6th hour. Looking forward to checking in with you guys. A couple of things as we talk about taxes. One, in the unit handout folder, so Unit 5 Financial Planning handouts folder, there is a Kahoot that you guys undoubtedly want to take a look at regarding some terminology for taxes. Taxes are very specific. There's very specific lingo that we need to understand. I would give that a peruse here in the near future before our exam so we can get that lingo down. But that is there for you. We are talking taxable income today, and then whatever time is left, you're finishing the Chapter 4 reading guide questions 10 through 23 for tomorrow, and be reminded again, I will be in the classroom tomorrow for 6 hours, so let's make sure we get this done. All right, taxable income. In addition to the United States tax system being progressive or graduated, we also need to understand that we do not pay taxes on every single dollar we make. We only pay taxes on something called taxable income. So how do we figure out what our taxable income is? Well, by January 30th of the following year, so for example, for 2024, all of the monies made last year, by January 30th of this year, anybody who worked would have received a couple of these documents. They would have received a W-2 if they were an employee of a business. They would have received a 1099 if they were an independent contractor of a business. These two documents are going to show a couple of things. On the W-2, they're going to show the total amount of money that a person made working for that company. And then it's going to show how much money was already paid in state and federal taxes. Those things are called withholdings. It's also going to show any contributions to retirement accounts such as 401ks, 403bs, potentially IRAs could be on there. But that's what a W-2 is going to show. 1099 for the independent contractor, it's just going to show you the amount of money that you were paid from that person or from that company, right? Because you are an independent contractor. Now, we have to be careful. If you're doing a lot of independent contractor work, such as myself working as a paralegal, I don't have any withholdings taken out of my check over the course of the year. I get paid throughout the year. At the end of the year, I get this 1099, and it's my responsibility to pay the state and federal taxes on it. If that's the case, if you are working as an independent contractor, then there's a pretty good chance that you may need to pay quarterly taxes over the course of the year so you don't get a penalty from the IRS. And those taxes are due on January 15th, April 15th, July 15th, and October 15th. But once we get these two documents by January 30th, and that's required by law, once we get these two documents by January 30th showing us all the money that we made as an employee of a company, as an independent contractor, we add up the amount of money that we were paid, and those things are called, or that number is called, our gross income. From there, we start taking subtractions from that number, trying to figure out our taxable income, because again, not every dollar that we make is taxable. Once we get our gross income, again, we start looking for our adjusted gross income. This would be your gross income minus any sort of adjustments. And there's a list that's published every year on the IRS website. What counts as an adjustment, what doesn't count as an adjustment. They change frequently over from one year to the next, so you have to keep tabs on these things. But for example, contributing money to a 401k or a 403b, that's an adjustment. Contributing money to an IRA, that's an adjustment. That lowers your taxable income from your gross income. And the ultimate goal is to get our taxable income, the money we pay tax on, as far as humanly possible from our gross income as we can. Once we figure out our adjusted gross income, then we take out our personal exemptions. Now, the last year that personal exemptions were allowed, that was in 2017, it was $4,050 for every person in a family. The government more or less decided that $4,000 for each person, that's not going to be taxed. This has since been dropped since Joe Biden was president. He increased something called deductions, which I'll get to in a second. But the reason I mention exemptions is there's a chance that those could come back in the near future. The pause on exemptions is supposed to go away in 2026, if I'm not mistaken. So again, we take our gross income, the total money we get, we add that up from our W-2s and our 1099s. We calculate our adjusted gross income. That would be anything minus the adjustments, anything minus the exemption, should they ever come back. And that gives us our adjusted gross income. Then we take our deductions. Now you can take a standard deduction or you can take an itemized deduction. Deductions, again, the IRS has a website that everything that you can deduct from your taxes, alimony payments, business use of your car, business use of your home, student loan interest. There's all these things that are deductible from your taxes. And again, it changes every single year. Now, there's two ways to do this. You can take the standard deduction, what the government allows you to take, no questions asked, or you can itemize. What the current rates are for deductions, for the standard deduction, in 2024, a single person could deduct $14,600 from their taxes. A married couple filing jointly can take away $29,200 from their taxes. And you'll notice that 14,600 times 2 is 29,200. So there's no real advantage there. If you're a single person with children, you actually get to deduct $21,900 as the head of household. But again, we take the total amount of money that we make, gross income, calculate our adjusted income, that is taking away the adjustments, such as retirement contributions. We subtract personal exemptions, which don't exist anymore. And then we choose between the standard deduction or the itemized deduction. And again, how this works and how you make the decision, if you can deduct more than the amount given per person or per couple, then you itemize. If you don't have $29,200 in deductions for a married couple, if you don't have $14,600, then you take the standard. And from one year to the next, in my own situation, we sometimes switch between taking the standard deduction versus taking an itemized deduction. And again, a lot of things play into this. Student loan payments, mortgage payments. You have property taxes, state and local taxes, SALT taxes. All of these things kind of add up quickly, so you have to keep tabs of it over the course of the year. Once we subtract all of these things, again, wait for it one more time, the adjustments, exemptions when they're there, standard or itemized deductions, we get to what our taxable income is. And it's the taxable income that determines what tax bracket we go into. So if we were to run through this example here, we've got a couple here, it makes $70,000 a year. They're married filing jointly. They have 3 kids. Their adjustments from their $70,000, they got $2,000 into an IRA, so that drops their taxable income down to $68,000. Then they got $900 in student loan interest, so that subtracts another $900 off the top. That brings their taxable income down to $67,100. Then we go into exemptions. We take $4,050 for the, what do we got, 5 people in their family. That's another $20,250, taking us down to, oh goodness, what is that? 46,750, if my math is correct, down to taxable income. And then these people throw in the deductions from 2017, right? If they're married filing jointly, they get to deduct another $12,700, bringing their, again, taxable income down to $34,150, which is more or less about half of where they started from. So this is a big savings. Now, some people might be a little upset here that the exemptions were taken away. What we need to understand is when the exemptions were removed in 2017, here were the original deductions. So the deduction, the standard deduction in 2017 was $12,700. In 2024, there was almost an additional $2,000 added to the standard deduction. So it wasn't a complete and total loss. You got to deduct more without question, but it is still a bit of a hit. So now we get this taxable income down to $34,000. And then we go into the tax bracket here. $34,000 puts them at the 15% tax bracket right here between 18,650 and 75,900. So the base amount of tax that they owe, again, this is very similar to our career project. The base amount of tax that they owe is 1,865. And then they're going to owe 15% on any additional money made above 18,650, which would be a remainder of 15,500. That's what they're going to pay 15% on. 15% of 15,500 is $2,325. So the total tax that these guys owe on $70,000 income is $4,190. Again, when it comes to taxes and understanding these terms, we have our gross income. That's the total amount of money that we make in a year. And then we try to get our taxable income as far away from our gross income as possible. We take adjustments. If exemptions come back, we'll take those. And then we take the deductions. Once we subtract those three things, adjustments, exemptions, deductions, we get to our taxable income. If you were to take the tax that this couple paid on their income, so we would say the average tax rate, basically what it is you divide the taxes owed out of the total amount of money that they made. They pay an average tax rate of 6%, which is, fundamentally different than what our tax brackets say on paper. And again, that's because we don't pay tax on every dollar that we own or every dollar that we earn. We only pay tax on taxable income. One thing to keep in mind is something called the marginal tax rate. You can see where these tax brackets are in here. One thing to keep in mind is if we start getting closer to one tax bracket to the next, we have to be careful on how much money we're bringing in. Now, I'm not saying, hear me say this, please hear me say this. I am not saying that you should pass on a raise, you should pass on a promotion, you should pass on a job advancement because you're worried about going into the next tax bracket and paying more in tax. That's not what I'm saying. Take the raise, take the promotion, take the job advancement. But what I am saying is when it comes to marginal tax rates, we need to be careful with additional income that we have coming in when it comes from investments. We may not want to cash out some of the investments that we have if the cash out from investments pushes us into the next tax bracket, because that could very well eat into the profits that we made from investments and give the government more of our money. Take the job advancement, take the promotion, take the raise. You can't give those things up. You can't pass on those. But when it comes to the marginal tax rate, we're talking about the taxes that we would pay on every additional dollar that we earn. And if it's coming from our investments, I don't know if it's wise to cash something out knowing that it could put us in the 25% tax bracket or 28% tax bracket, knowing that we are eating into the gains, capital gains that we realized. Tomorrow we're going to get into a little tax strategy. Okay, a little bit of review today, a little tax strategy. Again, tomorrow I'm going to be in class. Tomorrow is Thursday. So you have the rest of the time to knock out the Chapter 4 reading guide. You have questions 10 through 23 for tomorrow. Hope you're all doing well, and I'll see you in class Thursday.